Welcome to Griffonomics. Imagine you're steering this massive, like 150-year-old cargo ship.
Okay, I'm picturing it.
Right, so you've got a reliable crew, a steady route, and a hold full of essential goods. But there is this fatal flaw in your navigation system.
Sounds dangerous.
It is, because every time the price of a single tree in Brazil fluctuates, your entire dashboard just goes blind. Your operating costs absolutely skyrocket, and you lose millions of dollars.
Oh, wow.
Yeah, and for a decade, you just, accept this as the cost of doing business. But what if one day you decided to just completely rip out that broken system, abandon the cargo that weighs you down, and buy a totally new, highly profitable engine?
Well, that is exactly the scenario we're looking at today. We have this really fascinating stack of sources in front of us, financial filings, M&A, slideshows, and the highly anticipated Q4 2025 earnings calls from Kimberly-Clark.
Yeah, the paper and tissue giant.
Exactly. And what these documents reveal is the what and why of a massive strategic inflection point. I mean, we are watching a legacy paper and tissue manufacturer engineer a complete transformation. They're turning into a global health and wellness powerhouse.
It's wild. And for you listening, whether you're an investor, a business leader, or just someone fascinated by corporate strategy, consider this deep dive a masterclass in survival. We're going to explore how a massive corporate entity can actually shed its legacy deadweight, grab onto entirely new demographic tailwinds, and completely change its trajectory without sinking the ship.
Right, but to really understand this transformation, we need to know what Kimberly-Clark actually is today.
Yeah, let's set the baseline.
Historically, this is a company built on a legacy core of absorbent products. We're talking about baby and child care with Huggies, adult care with Depend, and family care with Kleenex.
Basically the stuff under every bathroom sink.
Pretty much. Geographically, they report their earnings across North America and International Personal Care, or IPC, and we really cannot understate the sheer scale of this operation. According to their 2025 filings, they generated $16.44 billion in net sales.
$16.44 billion. That's huge.
It is. And to give you a sense of their retail footprint, Walmart alone acts as their primary commercial engine. Walmart represents a full 16% of their total global revenue.
Okay, let's unpack this. If you have a $16 billion engine just humming along and your products are in practically every household, the instinct for most executives is to just protect the status quo. Don't rock the boat.
Right, exactly.
But Kimberly-Clark initiated what they call their 2024 Transformation Initiative. Why mess with an engine that is already generating that much revenue? I mean, it's like a cargo plane upgrading its engine mid-flight so it can carry a massively heavier payload later.
That's a great way to put it. And the reason is, revenue isn't the same as high-quality, resilient growth. The first step of their transformation, before they even looked at buying new companies, was turning that massive revenue engine into a hyper-efficient productivity machine.
Which we see in the numbers, right?
Yes, we see the proof of that in their Q4 2025 numbers. They delivered 1.7% organic sales growth for a full fiscal year.
Okay.
And that actually bumped up to 1.8% in the fourth quarter. But here is the critical data point hidden in the earnings call. This marks their 8th consecutive quarter of positive volume plus mix.
Okay, let's pause right there. Because volume plus mix is one of those corporate terms that, honestly, it sounds like a smoothie recipe.
It really does.
But it's actually incredibly important. Just to ground that for you listening, if a company is only growing its revenue by raising prices, that is not sustainable.
No, eventually consumers just tap out.
Exactly. Positive volume plus mix means people aren't just tolerating inflation pricing. They are actually buying a higher total volume of products, and they are choosing the more premium, expensive options in the lineup.
Exactly. It proves that consumer demand for their core brands is structurally healthy, like people are actively choosing the premium Huggies over the budget options. But Kimberly-Clark didn't stop at top-line growth. The Transformation Initiative is really a story about ruthless internal efficiency.
Oh, the productivity numbers are insane.
They really are. In the fourth quarter of 2025 alone, they hit a staggering 7.2% in gross productivity savings. They are on track to hit a massive $3 billion productivity goal by 2030. And that's alongside another $200 million in purely administrative SG&A savings.
I want to know how a 150-year-old company actually finds $3 billion in the couch cushions. Massive corporations are usually famous for their bloat, not their agility. What are they actually doing on the ground to hit 7.2% productivity savings in a single quarter?
Well, it comes down to what they call using science as a competitive advantage, and it requires brutal prioritization. Let's look at their innovation pipeline.
Okay.
Historically, a giant company like this has hundreds of pet projects floating around in R&D. Kimberly-Clark had about 300 disparate regional innovation projects.
300.
Yeah, 300. And in a 12-month window, leadership stepped in and aggressively consolidated those 300 projects down to just 11 global platforms.
That is wild. I mean, killing nearly 290 projects in a single year means you are slaughtering a lot of sacred cows.
Howdy.
There had to be executives who spent years championing those projects who were suddenly told, your work is dead.
Oh, absolutely.
Yeah.
It's the definition of ruthless focus, and it is incredibly hard to execute culturally.
Right.
But mathematically, it's undeniable. By funneling all their R&D budget and their top talent into just 11 platforms, the innovations they're producing are substantially more profitable.
Now, how much more profitable?
Well, the filings note that products coming out of these 11 platforms carry margins that are 280 basis points higher than their base business.
And for anyone who doesn't speak Wall Street, a basis point is just 1/100%. So 280 basis points means these new products are yielding an extra 2.8% in pure profit margin.
Right.
In the consumer packaged goods world, where margins are notoriously razor thin, an extra 2.8% of pure profit across billions of dollars in sales is an absolute goldmine.
It really is. And they are pairing this focused R&D with technological execution. Like, they detailed an incredible pilot program using generative AI with a key e-commerce partner.
Right, the digital listing thing.
Yeah, they applied AI to their Huggies and Wipes digital listings, and it reduced the time required for digital platform work from 2 full weeks down to just 2 days.
Okay, that sounds like a great time saver for an intern, but how does faster digital listing work actually move the needle for a multi-billion-dollar corporation?
It all comes down to the mechanics of e-commerce algorithms. In digital retail, speed to shelf is everything.
So whoever's first wins.
Basically, if you can get your new optimized product listings live in 2 days instead of 2 weeks, you capture the first wave of consumer searches before your competitors even have their products online. You dominate the search algorithm early, which creates this massive snowball effect of reviews and sales.
That makes a lot of sense.
And because of that speed advantage, Kimberly-Clark drove 200 basis points of share growth in that specific e-commerce channel.
Wow, so by moving faster, they literally stole 2% of the total market share from their competitors. That is a brilliantly efficient engine.
It is.
But, reading through these historical filings, having a flawless engine hasn't really saved them in the past, because if your highly efficient cargo ship is constantly being forced to sail through unavoidable violent economic hurricanes, your efficiency doesn't really protect your profits.
That's the perfect way to look at it. And for Kimberly-Clark, the hurricane has always been the global commodity markets. What's fascinating here is, if you look at their track record over the past decade, they have suffered from extreme volatility in their earnings per share.
And it wasn't because people stopped buying toilet paper or diapers.
No, not at all. It was almost entirely tied to the highly unpredictable costs of global pulp and fiber.
Which goes back to the tree in Brazil from our opening scenario.
Precisely. Eucalyptus pulp is a globally traded commodity. Its price fluctuates based on weather patterns, supply chain disruptions, global demand. When pulp prices spiked, Kimberly-Clark's bottom line simply got hammered.
Yeah, they couldn't control it.
They couldn't innovate their way out of it, and they couldn't just pass all those sudden costs on to the consumer without destroying demand. It was a massive structural vulnerability.
So if you can't control the weather and you can't control global commodity traders, what do? You completely reshape your portfolio. And they started pruning aggressively. First, they deliberately walked away from $650 million in North American private label contracts.
That is a fascinating strategic choice, because private label means you are manufacturing the generic store brand tissue or diapers for a major retailer. It's guaranteed volume, which companies usually love.
But it's a trap, right? If you are the invisible manufacturer for a store brand, you take on all the commodity risk of buying the raw pulp, but the retailer captures all the brand loyalty from the consumer. You are just a nameless factory to them.
Yep, you take all the risk, they take the credit.
Exactly. So Kimberly-Clark walked away. They dropped their private label exposure to under 1% of their sales. They essentially said, look, we are no longer in the business of subsidizing other people's brands with our supply chain. We are focusing purely on our premium, high-margin brands.
And then they took an even more radical step to kill the volatility. This is the first half of the tale of two deals we mentioned earlier. Kimberly-Clark announced they are spinning off their International Family Care and Professional segment, known as IFP, into a joint venture with a company called Suzano.
And Suzano happens to be the world's largest producer of eucalyptus pulp.
Exactly. Under the terms of the deal, which is expected to close in mid-2026, Suzano is buying a 51% controlling stake in the joint venture for roughly $1.7 billion, and Kimberly-Clark retains a 49% equity interest.
Now, why should you care about a corporate pulp joint venture in South America? Because this is a vital masterclass lesson in risk management. Think about your own business, your department, or even your career. Kimberly-Clark identified the exact uncontrollable variable that caused chaos in their financial life, the cost of fiber.
Right.
Instead of just complaining about it or trying to buy complex financial hedges year after year, they structurally partnered with the lowest cost producer of that exact material in the world.
They realized they weren't actually in the paper business. They were in the consumer care business. The trees were just an expensive, volatile distraction.
Yes.
So by shifting the ownership of that commodity risk to Suzano, the people who actually grow the trees best, Kimberly-Clark eliminated their exposure entirely.
And the knock-on effect of that is massive. It fundamentally shifts their remaining corporate portfolio so that 2/3 of it is now personal care. That's a much higher margin category, and it's far less reliant on raw commodity swings. They protected their bottom line, insulated their earnings, and secured $1.7 billion in cash in the process.
Which brings us to the pivotal question. Once you stabilize the ship, get out of the storm, and secure a pile of cash, what do you do next? A safe, insulated company isn't automatically a growing company. They needed to buy their way into a higher margin future.
And here's where it gets really interesting. In November 2025, Kimberly-Clark executed a massive $48.7 billion cash and stock acquisition of Kenvue. And if you don't instantly recognize the corporate name Kenvue, you definitely know what they make.
Oh, for sure.
They own Tylenol, Neutrogena, Listerine, Zyrtec, and Band-Aid.
To contextualize the sheer scale of this move, this transaction creates a $32 billion pure-play consumer health juggernaut. I mean, we're talking about an entity that generates $7 billion in pre-synergy EBITDA.
Just to quickly define that for you listening, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is essentially the pure cash this business generates from its daily operations before accountants and tax structures get involved. A $7 billion EBITDA is a phenomenal cash-generating engine.
It is massive, and the market recognizes it. The merger was overwhelmingly approved, with over 96% of shareholders voting yes, and it is on track to officially close in the second half of 2026.
Okay, wait, I have to push back here. 96% shareholder approval sounds great on paper, but let's look at the reality of what they're actually combining. Kenvue is a pharma legacy company.
Right.
They spun out of Johnson & Johnson. They have a pharmaceutical mindset. You are bolting that onto Kimberly-Clark, which is a legacy consumer tissue and diaper company. Isn't integrating a pharma legacy company into a consumer tissue company basically mixing oil and water? Like, how does this actually work? Honestly, it sounds like an absolute culture clash.
It's a very valid concern, and culture clashes destroy a lot of M&A deals. But if we connect this to the bigger picture, it's not about blending their cultures. It's about combining their mechanical strengths.
What do you mean by mechanical strength?
Think about it like this. It's like taking a world-class logistics company, say FedEx, and suddenly handing them the exclusive patent for the cure to the common cold. Kenvue has the high-margin, scientifically backed products, the Tylenol, the Zyrtec.
Right.
But Kimberly-Clark owns the delivery trucks that already go to every single retail neighborhood in the world. Kimberly-Clark has a legendary commercial execution playbook in North America. They have been ranked #1 in the Advantage Retailer Survey for 3 years running. They know exactly how to negotiate shelf space with Walmart and Target, and they know how to move massive volume.
Ah, I see. So Kimberly-Clark doesn't need to learn how to invent Tylenol. They just use their existing supply chain dominance and their deep retailer relationships as a superhighway to push Kenvue's products harder and faster than Kenvue ever could on its own.
Exactly. And the geographic synergies make this a perfect puzzle fit. Kimberly-Clark dominates in North America, China, Mexico, South Korea, and Indonesia. They can instantly plug Kenvue's brands into those deeply established networks.
That makes sense.
But the reverse is also beautifully true. Kimberly-Clark has historically struggled to gain a foothold in India after a joint venture with Unilever ended a few years ago. They lost their physical distribution footprint in one of the fastest-growing markets on Earth.
Oh, let me guess. Kenvue already has a massive footprint in India.
Yep. Kenvue brings 3.1 million points of distribution across India and Western Europe. Kimberly-Clark can use Kenvue's established highway in those regions to push Huggies and Kotex into the exact geographic gaps they've been trying to fill for years. It fixes Kimberly-Clark's Indian distribution weakness practically overnight. It is a brilliant geographic swap of strengths.
Okay, the strategic map and the geographic swap make total sense. But we have to talk about the financial realities of 2025 and the massive market skepticism we are seeing. Because buying a $48 billion company is incredibly expensive, and the short-term numbers look rough.
Very rough.
Kimberly-Clark's full-year 2025 diluted EPS, earnings per share, was $4.86. That fell 24% year over year. That is a massive drop, and it heavily reflects the short-term restructuring costs required to make this pivot toward premiumization.
The market is naturally and rightfully skeptical of the leverage and the massive equity dilution taking place here. To fund the stock portion of the Kenvue acquisition, Kimberly-Clark is issuing approximately $280 million entirely new shares.
Wow. If I'm a legacy shareholder who has held Kimberly-Clark's stock for a decade, that is a huge pill to swallow. By issuing 280 million new shares, you are drastically watering down the value of the shares I currently own. The filings note that legacy Kimberly-Clark owners will only hold roughly 54% of the newly combined entity. I basically just lost nearly half my voting power and proportional ownership.
You did. It is a massive dilution of ownership. Furthermore, to fund the cash portion of the deal, which comes out to $3.50 per Kenvue share, Kimberly-Clark is taking on substantial debt. And because they are taking on that debt, they face a strict leverage test. The company announced that their stock buyback program is essentially suspended. They will only repurchase shares to offset the dilution from employee equity compensation.
So they aren't buying back stock to drive up the share price anymore. How long does that suspension last?
It remains in place until they hit a target of 2.0x net leverage. Net leverage is basically a ratio of a company's total debt compared to its EBITDA, its cash flow. They need to pay down debt and grow cash until their debt is only twice their annual cash flow.
That could take a while.
It could. For traditional Kimberly-Clark investors who historically loved this stock specifically for its steady dividends and aggressive buybacks, this new reality requires a lot of patience.
So what does this all mean? We have a leaner, hyper-efficient core business that just killed 290 zombie projects. We have a clever Pulp spinoff to Suzano that completely eliminates commodity volatility. And we have a massive, highly expensive, debt-heavy acquisition of Kenvue to buy long-term growth. When you weigh the short-term financial pain against the strategic upside, where does the dust actually settle? What is the 2027 growth play?
The final verdict, based on the strategic outlook mapped across these M&A filings, is that this is rated as a strong long-term buy and a massive value creation opportunity.
Okay.
They are very clear about the timeline. Year one post-close, so late 2026 into 2027, we'll see EPS dilution.
Yeah.
It is going to look incredibly messy on the income statement as they absorb the debt and integration costs. But by year two, the targets point to high margin accretion.
Accretion meaning the deal actually starts adding real positive value to the earnings per share rather than dragging it down?
Correct. And that accretion is driven by one massive number, $2.1 billion in targeted net synergies.
I have to challenge that. Every time two mega corporations merge, the executives stand on a stage and promise billions in synergies. It's usually a spreadsheet fantasy that never materializes because integrating two massive IT systems and HR departments is an absolute nightmare. Why should we believe they can actually extract $2.1 billion in value just by combining these companies?
It's a fair challenge, but this goes back to your earlier point about the culture clash between a pharma company and a tissue company. Kenvue, because it was born out of Johnson & Johnson, carries a heavy, expensive pharma legacy cost structure. They have bloated administrative layers, expensive legacy marketing contracts, and high overhead.
Which Kimberly-Clark doesn't have.
Right. Kimberly-Clark is coming in with their hyper-lean powering care operating model. They are taking the exact same ruthless focus that allowed them to cut 300 projects down to 11, and they are applying it to Kenvue's corporate bloat.
So they are essentially playing the role of a highly efficient private equity firm.
Exactly. They expect to generate $1.9 billion in pure cost savings just by optimizing Kenvue's general and administrative expenses, streamlining their supply chain cost of goods sold, and applying AI and efficiency metrics to their marketing spend. When you add in another $200 million from the revenue growth of putting Kenvue products into Kimberly-Clark's global distribution network, you hit that $2.1 billion target. It is aggressive, but mechanically, The redundancies are very real and very cuttable.
So if we look at the overarching strategy here, it perfectly distills into a single defining theme: risk defined, portfolio protected.
I couldn't agree more. It perfectly encapsulates the entire transformation.
To summarize this massive pivot, we are watching the real-time granular engineering of a 150-year-old legacy paper company. Just a few years ago, they were locked in low-growth categories, completely at the mercy of unpredictable global pulp prices and Brazilian weather patterns. Today, they have surgically carved out that volatility.
Yeah, they really did.
They traded the unpredictability of trees for the highly predictable, demographic-driven tailwinds of an aging global population that requires health and wellness products. They built a better engine, they navigated out of the storm, and they bought the exact cargo they needed for the future.
It is a phenomenal masterstroke in corporate reinvention. And I want to leave you with a final thought to mull over. We have spent this entire deep dive looking at balance sheets, global M&A strategies, and supply chain mechanics. But I want you to bring it down to a human level.
Okay.
If a 150-year-old traditional manufacturing company, one of the most massive, slow-moving corporate ships in the world, can completely redefine its identity, its risk profile, and its future simply by deciding to carve out its weaknesses and acquire a totally new expertise, what long-held assumptions in your own career or your own industry are actually just choices you haven't decided to change yet?
That is the perfect question to leave on. Thank you for joining us for this deep dive. Keep questioning the obvious, keep looking for the bigger picture behind the numbers, and we will see you next time.